Hello everyone, it's John AG here, and I need you to lock in for the next few minutes because something just happened in the silver market that should make every small investor sit up straight. In the last few weeks, an avalanche of silver didn't just trade on a screen. It got called for, demanded, and pulled toward delivery like someone with a serious agenda was sweeping the table clean. And here's the wild part. This wasn't even supposed to be a big delivery season. Yet the numbers being demanded look like the kind of move you'd expect from institutions, governments, or industrial giants that cannot afford to be short when the music stops. So today I'm going to break down exactly what happened, why it matters more than the daily price, what the paper market is quietly vulnerable to, and why the next phase could be faster, messier, and way more explosive than most people are prepared for. But before we dive in, quick support request. I'm running a campaign to eliminate copycat channels that rip the work and re-upload it with zero value. If you actually value original analysis, subscribe right now and comment OG John AG so I can see who's really riding with us. Also, if you want daily updates, quick posts, and my personal analysis that I don't always why this matters more than the daily price put on YouTube, I created a WhatsApp channel and community. The link is in the description. Join it because I drop premium posts there, including instant voice notes and fast updates when markets move. Now let's get into the event itself, because within the first 15 seconds, you should already know the headline. Massive amounts of physical silver have been standing for delivery, and it's happening again and again, month after month, at a scale that changes the entire conversation. Most people think silver is just a price chart and a ticker. That's the trap. The real story is the difference between paper promises and actual metal. And you can see that difference when big players stop rolling contracts and start saying, no, deliver it. Think about it like this. A futures market can look deep and liquid right up until too many people ask for the thing that the contract supposedly represents. And when that happens, the weakness isn't the price, it's the plumbing. Here's what set off the alarm bells. In one recent month, close to 70 million ounces were effectively demanded for delivery. And then right after that, another huge chunk followed in the next month. Tens of millions more. Add those together, and you're looking at a staggering figure that pushes toward 100 million ounces being called for in a very short window. If you're new, that isn't normal traffic. That's not casual speculation. That's not retail chasing a move. That's strategic accumulation. And it has one scary implication. Someone is choosing counterparty free metal over paper exposure. Now ask yourself the question nobody wants to say out loud. Who does that at this scale? Is it a federal entity building reserves? Is it an industrial buyer that needs supply security more than it needs a good entry price? Is it a group of funds that finally realized the tightness in physical supply and decided to front or run the crowd? Or is it some combination of all three? Drop your best guess in the comments because I want to see what you think is really going on behind the curtain. And while you're thinking about that, remember, by the time you're watching this, a members-only video should already be published on this channel that bundles the latest updates in one place. If you want the full timeline plus deeper context, join the membership and watch that video. Premium members will get the in-depth analysis we don't always share publicly. It also shows me who's truly following the work. Now, let me explain why these delivery numbers matter more than any headline. A futures market can create the illusion of endless supply because contracts can be resold, rebar-oroed, and rehypothecated, meaning the same underlying claim gets recycled again and again. That creates volume, it creates liquidity, it creates fees, and at paper versus physical. The real vulnerability creates a comfortable fiction that everything is fine because most traders never ask for delivery. They close the position, they roll it, they cash settle, they move on. But the moment too many people decide I want the silver, the entire game changes. Because paper is easy to manufacture and physical is not. This is why delivery behavior is a louder signal than the price candle. Price can be managed for a while, narratives can be engineered, but you can't fake the act of removing metal from the pool without revealing stress somewhere else. And that's why this feels different than the usual market noise, because it's not a one-off, it's recurring. Month after month, huge amounts are standing for delivery, even in months that are not supposed to be heavy delivery months. If you're seeing that kind of demand in an off month, what do you think happens when a major month hits? That's one cliffhanger to keep in mind. Let me slow this down and make the mechanics simple. Because once you understand the mechanics, you'll see why these delivery surges are like smoke coming out from under a locked door. On paper, a futures contract is just a standardized promise. A buyer and seller agree on a price for a future date. Most of the time, nobody wants the physical. They want exposure. They want to trade, they want to hedge, they want to flip a position and move on. So the system is built around the assumption that the vast majority will never ask for physical settlement. That assumption is what makes the leverage possible, and leverage is what makes the volume look gigantic. Now here's where it gets interesting. When a contract reaches the point where delivery can be demanded, a buyer can choose to stand for delivery instead of closing the trade. Standing for delivery means you're not just betting on silver. You're requesting the silver. You're basically raising your hand and saying, I'm not here for a spreadsheet, I'm here for the bars. And when enough buyers do that, the system's flexibility tightens because the market can create more contracts quickly, but it cannot create more refined metal quickly. This is why physical drain is the real pressure. Now, you might be wondering, John, why would anyone stand for delivery through an exchange if they can just buy elsewhere? Great question. Sometimes it's because the buyer wants transparency of process. Sometimes it's because they want a specific pipeline. Sometimes it's because they want a forced discovery, like stress testing a structure. And sometimes it's because they know the exchange is the place where paper and physical meet. And if you want to expose weakness, that's where you do it. Now, there's another piece of the puzzle most people ignore. Inventories are not one simple pile. There are categories. There are bars sitting in vaults that are available for delivery and bars sitting in vaults that are stored but not committed. There are bars that are eligible and bars that are registered. And I'm not going to drown you in jargon, but the point is this. When delivery demand spikes, the important pool is the one that's actually tied to delivery commitments. That pool can shrink faster than the headline inventory numbers suggest. And when that pool shrinks, the incentives change, premiums change, lease rates change, spreads change, and eventually price has to respond. But price doesn't. Who could be behind the buying and why always respond first? Sometimes it responds last, which is why this is so dangerous for anyone who only watches the chart, because the chart is a lagging reflection of the tug-off war happening in the warehouse. Now, let me give you a scenario, and tell me if this sounds far-fetched. Imagine you're a large industrial buyer. You make products that require silver. Your sales team is booked, your factory is running, your contracts with customers have delivery deadlines, and suddenly you start hearing whispers that supply is tightening, not in the retail coin market, but in the wholesale pipeline. Your procurement team sees longer lead times, your suppliers start adding conditions, and you realize that if you get caught short, you don't just lose a trade, you lose production, you lose customers, you lose market share. So what do? You don't buy a little in hope. You secure a stockpile, you overorder, you lock in feedstock, you pay a premium if you must, because the cost of being wrong is bigger than the cost of paying up. Now take that mindset and add governments. A government doesn't think like a retail investor. A government thinks in terms of vulnerabilities, inputs, strategic industries, defense readiness. And if silver is increasingly treated like a critical input, then governments will behave exactly like you'd expect. They'll try to make sure they are not dependent on someone else's exports during a crisis. So they stockpile, they prioritize domestic usage, they sign agreements, they coordinate, and again, they won't announce it with fireworks. They'll do it quietly. Now add funds to the same room. Funds see a trend. They see a breakout. They see a macro thesis. They see currency debasement. They see deficits. They see a world that feels less stable, and they want something that isn't someone else's liability. So they buy metals. But here's the twist. Some of them don't just want exposure. They want to reduce counterparty risk. They want to own it in a way that doesn't require trusting a chain of promises. That's why delivery becomes attractive. And when funds and industry and governments all start tugging on the same rope, the rope snaps. Now, this is the point where the paper versus physical debate gets real, and it stops being internet drama because the paper market works fine when physical demand is modest relative to claims. But if claims multiply and physical is steady or shrinking, the ratio becomes a problem. And the way markets resolve ratio problems is not by giving everyone what they want. It's by repricing, rationing, or changing rules. Sometimes all three. That's why this matters for small investors, because small investors are usually told, don't worry, there's plenty, until suddenly there isn't. Now let's bring it back to the numbers without copying anyone's phrasing. When you see delivery requests measured in tens of millions of ounces and you see it happening repeatedly, you're looking at a behavior change. And behavior change is what precedes structural change. I don't care what the talking heads say. I don't care how calm the headlines feel. Behavior is truth. Now, one thing that keeps coming up in these conversations is the idea that some buyers are skipping the Western market entirely and going upstream, buying semi-refined material, working directly with producers, paying premiums to supply pressure. What most investors ignore: secure flow. That should tell you something important. When buyers fear future availability, they stop optimizing for price and start optimizing for certainty. That's a classic signal of emerging scarcity. And you can see the same pattern in other commodities historically. When the supply chain becomes a battlefield, money stops acting like money and starts acting like a weapon. Now, here's a cliffhanger that you need to remember. If the biggest buyers are accumulating quietly, who is on the other side of that trade? Because every contract has a seller. Every ounce demanded has a liability attached somewhere. And if sellers assumed most contracts would be rolled, but more contracts are being demanded, then sellers are forced to source metal in a tighter environment. That's where stress concentrates. Now, I want to talk about the banking angle in a careful way. There have been reports and chatter in financial circles that the positioning among major institutions has been shifting. Some appear to be reducing risk. Some may be moving from being aggressively short to being more neutral, or even positioned to benefit from rising prices. And if that's true, it means the smart money is doing what it always does. It adjusts before the crowd because the crowd learns through pain. Institutions learn through information. Now, does that guarantee anything? No. Markets can do weird things, but it does reinforce the core point. The real story is not the day-to-day candle. The real story is the flow of physical and the incentives of those who can't afford to be wrong. Now let's talk about the timeline because people always want a date. I'm not going to give you a magical date like a fortune teller, but I can tell you how these situations typically evolve. First, physical tightness shows up in obscure places, delivery behavior, premiums, procurement. Second, policy tightness shows up, export restrictions, strategic lists, domestic prioritization. Third, price tightness shows up, moves through resistance, jumps, gaps, violent pullbacks. Fourth, narrative tightness shows up. Suddenly, the media discovers the story and everyone acts like it's new. We are somewhere between the first and second phase, in my view, and that's why watching now matters. Now, I also want to address a common trap. Some people see price run and they think it's too late. But in a repricing cycle, late is not about the first move. Late is about the moment the public piles in after the structure has already shifted. If the system is moving from a paper-dominant regime to a physical stress regime, then the new normal price can be far above the old range. In other words, you can feel like you're late while you're actually early for the bigger move. That's why understanding regime matters. Now you might be thinking, okay, but why would this go viral? Why would people care? Because silver is the one metal that sits at the intersection of money and industry. Gold is mostly monetary, copper is mostly industrial, silver is both. It's monetary enough to be hoarded, it's industrial enough to be consumed, and that makes it explosive in a world that is electrifying everything. More solar, more electronics, more power infrastructure, more defense tech, more what to watch next, the next move setup, sensors, more automation. All of it leans on silver in some way. So when the pipeline tightens, the pressure spreads. And when pressure spreads, attention follows. Now I want to insert another quick engagement point. If you're still watching up to this point, you're already ahead of most people. So do me a favor, type still here in the comments if you're locked in, because it helps the algorithm understand this isn't a drive-by view. And if you've had a silver win, maybe you bought early, maybe you flipped something, maybe you stacked patiently, share that too. Your story might be the push someone else needs. Now let's deal with the melting ice cube concept without turning it into a lecture. And we're not done. Here's another. When delivery rises, while mainstream coverage stays quiet, that silence usually tells you the implications are uncomfortable. Because if regular people understood what standing for delivery really signals, it would change behavior. And behavior is the one thing a paper system cannot control forever. Now, one of the most important background developments is this. Silver has been moving into the category of strategic material in more than one jurisdiction. When a metal is treated like a critical input, it stops being just an investment story. It becomes a supply chain story. It becomes a national security story. And once it becomes that, governments don't behave like traders. They behave like hoarders. They stockpile. They restrict exports. They prioritize domestic needs. And they do it quietly because broadcasting scarcity invites panic. Now add another factor, refining power. If a country or a bloc controls a large chunk of global refining, it can throttle the flow without touching the mines. It can effectively decide what gets shipped, what gets delayed, and what gets kept. And if export rules tighten at the same time that deliveries surge, you have a squeeze forming from multiple directions. This is the part where I need you to slow down and really picture what's happening. On one side, you have a paper market built on claims. On the other side, you have real-world demand that cannot run on claims. A solar panel factory cannot install paper silver. A defense contractor cannot wire paper silver. An electronics manufacturer cannot solder paper. They need the atoms. And once industrial demand starts acting like a buyer of last resort, price discovery stops being polite because they don't get to say, oh, it's expensive, we'll just wait. Their entire production depends on it. Now let's talk about something that should scare every bank and every naked short position in the space. The moment delivery becomes fashionable, the ability to endlessly roll and recycle claims begins to break down. It's the same reason every financial scheme collapses the moment withdrawals exceed inflows. As long as people accept statements and don't ask for redemption, the system looks stable. But when enough participants say, give me the underlying, the system is forced to prove it has what it sold. That's why delivery is the vulnerability. And that's why a coordinated shift toward a practical framework for small investors' delivery is a threat. Now, I want to make a clear distinction so nobody misunderstands me. I'm not saying every contract is fraudulent. I'm not saying every exchange is empty. What I'm saying is simpler and more important. A paper system is stable only when redemption demand stays low. And right now, redemption demand is not low. It's rising, it's persistent, and it's coming from entities that are well-funded, well-connected, and likely informed. That's why this matters, because retail isn't leading this. Retail always arrives late. Retail gets the scraps. Retail gets the headlines after the supply is already spoken for. So if you're waiting for the mainstream to give you a neat little alert that says, hey, physical tightness is here, you're going to get that alert after the easy part is gone. Now let's address the elephant in the room. Who is taking it? When you see tens of millions of ounces being demanded, you have to consider the categories. Industrial giants that need long-term supply. Governments that think in decades, not quarters. Funds that can move billions without blinking. And yes, sometimes a mix of them using different channels, so it doesn't look like one big buyer. You might see direct deals with miners. You might see purchases of concentrate or door. You might see standing for delivery and exchange warehouses. The common theme is the same. Secure supply first, worry about optics later. And if some buyers are willing to pay above what others pay, that isn't irrational. That's a premium for certainty. That's a premium for survival. Now, here's a retention check. If this delivery trend continues, what breaks first, price or the confidence in paper? That's not a trick question. Price can be managed for a while. Confidence is harder to manufacture once physical gets tight because every extra ounce pulled out of circulation makes the next ounce more valuable, and every month of heavy delivery tightens the spring. Now, I want to talk about the supply side because this is where silver becomes uniquely dangerous in a shortage environment. A lot of people assume higher prices automatically bring more supply. That's true in some commodities, but silver is weird. A large portion of global silver production is not from primary silver mines. It's produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply does not scale quickly with silver price, because the decision to increase production depends on those other metals, those other economics, those other projects. So even if silver price screams higher, supply doesn't instantly respond. And in a world where final thoughts plus your turn in the comments demand is rising from multiple fronts, industry, investors, governments, that is a recipe for violent repricing. Now let's add another layer. Silver's usage profile. Gold is hoarded. It sits. It can be recycled easily because it's stored in large bars, coins, and jewelry. Silver gets consumed. Silver gets used in tiny quantities in millions of products. And because it's used in small amounts, it often isn't recycled. It ends up dispersed. It ends up in landfills. It ends up effectively gone. So silver is not just scarce because of mining. It's scarce because of physics and economics. Once it's used, it's hard to recover. And that's why sustained deficits matter. If you have multiple years where demand exceeds supply, you don't reset the system overnight. You drain inventories, you thin buffers, you reduce resilience, and then one day, a small shock becomes a huge crisis. Now here's another cliffhanger. If the public is last to the party, who gets caught paying the highest prices? It's almost always the late wave, because early buyers accumulate quietly. Then industrial buyers panic. Then funds chase performance. Then retail arrives because they see the chart. And by the time retail arrives, the market is already in a different regime. That's why you don't want to wait for perfect confirmation. You want to understand the structure while it still looks boring to everyone else. Now let's talk about the ratio story because it's one of the simplest ways to explain how distorted silver can become. Silver is mined in far smaller proportion compared to gold than the market often prices it. Historically, the price ratio between gold and silver has swung wildly. At times, silver has been priced so cheaply relative to gold that 1 ounce of gold buys an absurd amount of silver. Those extremes don't last forever. Markets tend to mean revert, and when they mean revert, they can overshoot. So if the ratio compresses, silver doesn't have to do anything mystical, it just has to become less undervalued relative to gold. And if that happens during a period of tightening physical supply, the move can be sharp. Now, I'm going to shift gears to something that ties all of this together, the currency side. Because part of why metals get revalued is not that the metals change, it's that the measuring stick breaks. If you measure a melting ice cube against another melting ice cube, you can convince yourself nothing is happening. That's why comparing currencies against each other often hides the real truth. A more honest comparison is to measure currency against hard assets. Measure it against gold, measure it against silver, measure it against things that can't be printed, and what you usually find is that currency purchasing power erodes far faster than official narratives admit. Now, one simple way to make this real is the housing example. People love to say homes went up, assets went up, everything is booming, but if you remeasure in gold, you often see the opposite. A house that doubled in dollars might be cheaper in ounces of gold, meaning the house didn't get more valuable. The dollar got weaker. And this is a brutal lesson. Inflation can make you feel rich while you're actually treading water. So when you see gold and silver going up, sometimes that's not them getting stronger. It's the currency getting weaker, and that weakness is built into a debt-driven system that expands over time. Now connect that to today's delivery trend. If sophisticated buyers believe currency purchasing power will continue to erode, and they also believe physical supply is tightening, what do you think they do? They front or run. They accumulate. They remove counterparty risk. They take possession. And they do it before the public understands why. Now, some people will ask, okay, John, but why doesn't everyone see this? Because the headlines focus on price. Because mainstream coverage likes easy stories. Because it's uncomfortable to talk about structural stress. And because the paper market works fine until it doesn't. That's the whole point. It's not supposed to look like a crisis until it is. So the question becomes, what should a small investor do with this information? First, don't panic. Second, stop letting the daily candle trick you into ignoring the structural signals. Third, think in terms of exposure and control. If you own something that depends on someone else's promise, you carry counterparty risk. If you own something you can hold, you reduce it. Now, I'm not telling you what to buy. I'm telling you what to pay attention to. Delivery, inventory movement, export rules, industrial procurement behavior. Those are the levers that matter when a market transitions from paper game to real-world fight. Now let's talk about the potential next phase, because this is where retention matters. If industrial buyers start to feel insecure, they don't buy a little, they buy a lot. They lock in supply contracts. They build stockpiles. They shift from just-in-time to just-in-case. And that shift can create an accelerant effect that pushes prices beyond what charts predict. At the same time, funds that chase outperformance will notice. They'll see metals outperforming other assets. They'll see breakouts. They'll see momentum, and they'll pile in because they can't afford to lag. Then finally, retail shows up. And retail will ask, why is silver moving? And the answer will be because it was moving behind the scenes for months and you were watching the wrong signals. That's how it goes. Now, I want to insert something important right here and keep it friendly. If you've had success in your life, business, investing, career, anything, share a line or two in the comments, not to flex, to motivate, because seeing real people win raises the morale of the community, and it reminds everyone that success is possible. Now, quick creative detour. If you want silver-related success stories, specifically people who turn small moves into real results, there's a link in the description to another channel focused on that. Subscribe over there too, and see how others have been making money and building a better life. All right, back to the core story. There's a reason the biggest buyers prefer silence. If a market is tight and you want to accumulate, you don't advertise your shopping list. You buy quietly. You spread it across channels. You use intermediaries. You use delivery mechanisms. And you let the price stay calm for as long as you can. Because once the crowd catches on, the premium for physical skyrockets. And that's why you should treat this period as formationally valuable, because it's not the final mania stage. It's the quiet accumulation stage. Now, I want to talk directly to the people who think this is all just hype. If you believe physical supply is abundant and paper is perfectly safe, ask yourself why buyers are choosing delivery over rolling. Ask yourself why direct deals for semi-refined silver are being discussed more often. Ask yourself why export restrictions and domestic prioritization keep showing up in policy language. Those are not the behaviors of a market swimming in surplus. Those are the behaviors of a market preparing for constraints. Now, here's another question for the comments that I genuinely want answered. If you could only pick one driver for silver's next major move, would it be industrial demand, government stockpiling, or investor panic? And why? Now, let me give you a practical framework because I don't want this to be just drama. There are 3 layers you should track. Layer 1, physical flow, deliveries, withdrawals, inventory changes. Layer 2, policy and supply chain, export rules, strategic classifications, refining bottlenecks. Layer 3, psychology. When the crowd finally understands the first 2 layers, they will react emotionally, and that's when volatility spikes. If you track these layers, you're less likely to get whipsawed by daily noise. Now, one more important mention, the WhatsApp channel. Again, if you want these updates in real time, join it. Because on YouTube, by the time a video is edited, uploaded, and watched, the market has already moved. On WhatsApp, I can drop a quick note or a voice update instantly when something changes. So use that link in the description and get plugged in. Now let's zoom out. We're in a world where multiple regions want supply security, where electrification increases silver demand, where defense and high-tech demand don't slow down just because prices rise, and where mining supply is constrained by geology, permitting, politics, and the fact that silver is often a byproduct. That combination is not a recipe for stability, it's a recipe for periodic shocks. And delivery behavior tells you that some very big players are positioning for those shocks right now. Now I can already hear the skeptics saying, "But John, markets always find a way." Sometimes they do, but sometimes the way is a much higher price. Sometimes the way is rationing. Sometimes the way is longer lead times, higher premiums, and tighter terms. And if you've ever run a business, you know what happens when supply becomes unreliable. You overorder, you build buffers, you lock contracts, and you stop caring about small price differences because the cost of shutting down is worse. That's the industrial mindset. Now imagine that mindset colliding with the hedge fund mindset. Funds chase returns. Industry chases continuity. Governments chase security. Retail chases narratives. When all four show up, something breaks. The only question is when. Now, I'm not trying to scare you. I'm trying to prepare you because preparation is calm. Panic is what happens when you ignore signals until the last minute. Now, as we wrap this up, I want you to remember the key takeaway from today's What Happened story. The event is not a rumor. The event is not a headline. The event is the surge in delivery demand repeatedly across months at a scale that suggests strategic accumulation. And once strategic accumulation becomes a trend, it tends to feed on itself. Because every buyer who arrives later has to pay more. Now, if you got value from this breakdown, do 3 quick things. First, hit subscribe so you don't miss the next update because this story is moving fast. Second, join the WhatsApp channel. App through the link in the description so you get instant voice notes and premium updates. Third, drop a comment, either your theory about who's taking delivery or simply OG John AG to support the campaign against copycats. And one more thing, if you want me to keep covering silver with this level of detail, deliveries, supply chain, policy moves, tell me in the comments so I know what to focus on next. Take care of yourselves, take care of each other.